Hello, my name is Steve Bigelow with the Candlestick Forum. Had kind of a relaxing couple weeks now with the 4th of July, but there hasn't been any change of investor sentiment, which was very easily identified based upon the indexes above the T line. We could see a couple weeks ago, we had kind of a J-hook pattern right here on the T line, implying that wave three was going to take us up to this level. That's the expectation coming off a fry pan, I'm sorry, a J-hook pattern. Wave one and wave three are going to be the same. The magnitude of wave three would have told us they were probably coming up to this level and through. And that's exactly what we've seen now over the last couple weeks. They've come up through this level that everybody else is watching as a resistance level, implying there's probably more upside again as long as we stay above the T line. However, the little red flag at this point is even though we're in an uptrend, we're starting to see a lot more bearish patterns working than bullish patterns. So the strategy at this point is you stay long, but have your safety stops in place. The T-line rule has made it very effective to stay long in the NASDAQ. As long as they can't close below the T-line, the uptrend remains in progress even when they opened it lower. This is a great advantage for the candlestick investor to see after they opened it lower, they started trading it higher and they still couldn't close it below the T line, telling us you still want to stay predominantly long. This has also helped in trades like NVDA. Over the last couple of days, it's pulled back right to the T line and doing a J hook. Still implies there's more upside. Sava, again, the T line rule. As long as you stay above the T line, you can stay long. This takes the anxiety and the whipsaw emotional aspect of investing out of the picture. As long as you use the T line rule and stay long, as long as it stays above the T line, the assumption is the uptrend remains in progress. We're using the patterns to take advantage of the big price moves. SIENA, if it breaks out through this level, expect another big move of this magnitude. Notice the little dimple right here. That usually projects about the halfway point of a pattern breakout on a fry pan bottom. This is not magic. This is just what the Japanese rice traders have illustrated occurs in human nature time after time. And it works just as effectively on the downside, the T-line rule. Notice our evening star signal. It told us they weren't coming back up above the T-line after our downtrend started. And all you do is stay short until you see a buy signal and a close above the T-line. If you're a little bit more aggressive, you probably would have covered the short position right here and then re-shorted here because we're still in a downtrend. So if we use that basic assumption that if we can see a pattern like a J-hook pattern that's going to start wave three that implies this resistance level is not going to act as resistance, this is where you can use 2+2 analysis. First, solar. You can see the J-hook pattern bouncing right off the T-line. And look where the resistance level is that everybody could observe. The fact that it's doing a J-hook pattern implies that if this trade's positive, it's going through, that this is not a resistance level anymore. Wave three should be in progress. So as long as the markets are staying above the T-line, you stay predominantly long. But up here in the overbought area, you want to move your safety stops up to a level where individual stock prices should not be trading. That'll be it. We'll see you in the chat rooms.